Good morning. My name's Patrick Malcolm. I'm a senior partner at GFM Wealth Advisory. Thanks to all our clients and guests for joining us today for our webinar with Munro Partners. Munro is an Australian-based and Melbourne-based, in fact, global manager with a core focus on global growth. Their flagship global growth fund has produced a return of 12.4% per annum since inception, which equates to a cumulative return of over 148% since inception about 7.5 years ago. Munro has 29 staff and has $4.7 billion of assets under management. Now, before I start the webinar with Nick, I do need to quickly show our disclaimer. Simply put, the advice today is general in nature, and if you have any particular questions about this investment or how it relates to your portfolio, please contact one of our advisors. Our special guest today is Nick Griffin. I won't get too detailed into his resume, but other than to say he's a partner and the Chief Investment Officer of Munro Partners and has 20 years investment experience. Thank you for joining us today, Nick.
Thanks very much for having me, Patrick.
Now, Nick, I like you a lot. You live in Melbourne. You grew up in Melbourne and went to Melbourne University.
I did.
You like your golf?
Yep. Not very
good.
good.
For Collingwood.
I do back for Collingwood.
Disappointing. Well, you can't be perfect though, can you?
I can't be perfect. It's a long story, but it was thrust on me.
That's okay. That's okay. Now, just to start with, our clients access your fund through MATE, which is by far my favourite ASX code, MAET, and comes up at the end in some brackets, hedge fund. So can you briefly explain what a hedge fund is, Nick, and the process of short selling as well and how it fits into your portfolio construction?
Yeah, okay. So thanks very much, Patrick, and thanks very much for your time, everybody, for dialing in. So yeah, Munro Partners, and obviously Patrick gave you some quick details there, but you know, as I said at the start, and I'll explain the hedge fund in a second, but we were set up in 2016, 8 years running. And our goal is to be your global growth investor. So most of what we're going to be talking about today is growth investing. As Patrick pointed out, we have 4 funds. The main fund is our absolute return fund, or our hedge fund, which is the code MAET. But I know some of the clients there also use our climate fund, MCCL, which we'll talk about later. And what we're essentially saying here in how we run our funds, and we have the absolute return fund, we have the long only fund, we have the climate fund, and we have a small cap fund. What we're saying with the hedge fund in particular is that it's just a little different to our other strategies. And so that's this one here. We have the ability to manage the net exposure over time. So we call it an absolute return fund. The goal of the fund is not to beat the index. The goal of the fund is to make you more than 10% per annum on a 3 to 5 year view. And so with that 10% per annum on a 3 to 5 year view, you know, that's an absolute number, not a relative number. And so what that means is we have these other tools in our arsenal that we can use to protect returns. And so the simple way we like to show this, and I'm just showing this today. So we're going to spend a lot of time today talking about growth equities, talking about our investment process, talking about, you know, stock picking, etc. But the MAET, the absolute return fund, has these other tools here that Patrick referred to, and they're really just designed to get you that 10% per annum through the cycle. And one is we can hold more cash if we want to. So we have in the past owned up to 40% cash. 2 is we can short sell, which is what Patrick mentioned. So that is you make money out of stocks going down. Best way to think about this is like kicking, since we're on footy, it's like kicking with your left foot. You kick better with your right, but sometimes you need to be able to kick with your left, and that's what shorting is. You just make money out of stocks going down. It doesn't work all the time, but it's very useful when things like COVID happen, etc. The last thing we do is we have the ability to buy put options. So we can buy put options in the market, again, very handy through periods like COVID. And the last one is, you know, you can buy more US dollars with the currency. And so this revolves around our capital preservation mindset. And so MATE is unique in the marketplace because it's growth equity with an absolute return mindset. And yeah, the other thing about having all these tools is, you know, we don't have an excuse for not getting you the 10% per annum through the cycle. We have all the tools available, and so we don't actually have an excuse. And so if the market didn't go up for a period of time or went down, then we're going to need to use these tools. And so that's how we smooth the returns over the journey, and that's how we've done it for a long period of time. And so that's what we talk about when we talk about a hedge fund. We're just talking about a mutual fund a normal fund, like same as any other fund on your platform, just with these extra downside protection tools that other people don't have.
Beautiful. Thanks, Nick. Now, just to pick up this on this growth theme, Munro is a growth manager, but it can mean many different things and it can come in very different forms. So how does Munro define growth, and perhaps sort of extending that, why do you think investors should look at the world in this way?
Yeah, so put really simply, we've always made sort of two observations about equity markets globally. And so just importantly, we're talking about equities. We're talking about global equities, so everything outside of Australia. And we're talking about growth. Okay. So when we think about growth, we think about earnings growth. Okay. So put really simply, we have a simple observation that companies that make more money every year, we generally think their share prices go up. Stocks ultimately follow earnings growth. Sustained earnings growth is worth more than cyclical earnings growth, and the market always misprices in growth and sustainability. So we're just going to make two observations. Here's two companies in the world. One's MasterCard, one's Bank of America. But, I could just as easily in Australia show you, Commonwealth Bank versus, say, Xero on the left. And what we would make the observation is, the grey line is the share price. The dark grey line is the share price, and the light grey line is their blended forward earnings per share. So what they think the earnings per share were going to be 1 year forward over a long period of time. And the observation is this is a cyclical company. This company is cyclical. It's just its earnings are going up or down based on the economy, based on interest rates, based on a whole bunch of things we have a view on, but we don't really have an edge. This company on the left is what we'd call a structural growth company, MasterCard. It's benefiting from the shift from physical to digital cash. Everybody knows this. Everyone's known this for a decade. The question was, would they be disintermediated? They haven't. And ultimately, the stock has just followed its earnings growth. And so when we talk about growth, we're talking about earnings growth. The other observation we'd make, just really quickly, is that we sort of think that structural, our job as if we're looking for earnings growth is to look for these structural growing companies. That's basically what we're trying to do. Because if we can find this situation over and over again, we're a chance of getting you towards that double-digit return number. And so when we think about growth, we're talking about companies that are growing their earnings more than 10% per annum. We'd also make the observation that we think this is all that really matters in the equity market. So if you think about equities is simply a game of thousands of companies, and the vast majority of them are just mediocre. Yet there's a handful that are just special. And so this special structural growth opportunity is effectively what you're looking for. I could show you heaps of studies, but the one I'd tell you is like a Bessenbinder study. If you just went and looked at every company that ever listed in the United States over the last 90 years, it's actually 25,400 companies. You would discover that 14,000 of those companies actually go to zero. The next 8,000 only offset what other 14,000 lose. And it's actually only 1,000 companies that generated the entire wealth of the US stock market over 90 years. And out of those 1,000 companies, the top 50 create nearly half the wealth. And so these are those top 50 companies. They've created nearly half of the S&P returns over 90 years out of 25,000 that listed. And it's always, we know who they are now because they're big winners, but it's always structural change that creates them. Whether it's digitalization, software, big box retailing, quick service restaurants, entertainment, airline travel. It's always the same. There's always a big structural change and there's always a couple of winners. Apple was the smartphone winner. Microsoft's the software winner. Walmart's the big box retailing winner. And so our job as a growth manager is just simply to occupy this top left-hand corner, find the big structural change, and that structural change will equal structural earnings growth for the big winner. And then your job is to just run those in concentrated portfolios. That's what we're trying to do for you. That's where we fit into your portfolio. And also in your portfolio, you've probably got bonds, you've got Aussie equities, a whole bunch of other things in there, but we're your growth manager. And our job is to occupy the top left-hand corner, find what's going to change, and then find the winners. And that's probably most of what we're going to be talking about today.
Sounds really easy, Nick.
No, it's not at all.
So just sort of to touch on that, I know you don't like to focus too much on the sort of macro environment, but just sort of looking at the environment that's been there for growth managers. So you had a really good run until sort of the end of 2021. Market went off the rails a little bit. And I hope you don't mind me saying the fund drew down. Yeah, fund drew down about 27%. But since March 2023, there's been a really good recovery and it's roared back, putting on 46%. So I guess maybe talking about the past, what's occurred, and how strong that's recovery been. You know, what's the short to medium term outlook?
Yeah, thank you. And yeah, look, this is all good points. And so maybe let's take a really big step back, you know, as to why did this happen? And yes, it definitely wasn't as smooth as what we would have liked. And why, in hindsight, we should have expected it to happen, and also why we think it's well behind us now, and why it's not too late to be looking into the future. And so this is just my entire financial career. So I'm showing you the S&P 500 from 95 to 2023. This is how long I've been doing this. God, I'm old. And
I wasn't going to say it, Nick. You said it.
yeah, way too long. Anyway, these are the big bear markets I've lived through. So this was 2000 to 2002. This was 2007 to 2008. There's a little bear market here, a little bear market here, and then a really big one in 2022. Now, these little ones this was COVID. This is probably not really a bear market. So you've basically got three big bear markets. COVID wasn't actually really a bear market. And I would just make the observation is what normally happens after you have a big bear market, like this one and this one, you end up having a long period of calm. And the reason why you have a long period of calm is because you've cleansed the financial system. Okay, so we got cleansed in 2022, and we had to manage that. And the reason why we got cleansed is what everybody knows is because interest rates that had gone down for a long period of time, went up rapidly from 0 to 5%. Why'd they go up? Because we came out of COVID and inflation came back. And it wasn't transitory. Well, it wasn't transitory enough for the Fed central banks not to have to do something about it. And so if the discount rate goes from 0 to 5, asset values fall, okay? Now, what had happened, you'd built up a whole bunch of excesses over this period of time. People had priced in 0% rates for a long period of time. And in the end, that's not what happened. We normalized. And so A, you had a lot of excesses built up, and B, you cleansed the system over a very short space of time. Classic bear market. Our job was to manage that. We managed that okay. In growth equities, it was, probably one of the biggest bear markets I've ever seen. It was significantly worse than the financial crisis in growth equities, probably about as bad as the dot-com crash. And so you effectively had this dot-com crash in growth equities. A lot of our growth peers would have fallen 40, in some cases 50%. We had to manage that. We didn't manage it as well as we liked. Those tools I talked about, they worked, but they didn't add as much value as we wanted. That's, however, past us now, okay? So from here, rates have effectively peaked. The derating in stocks is over. The only reason why stocks would derate further is if interest rates went from 5 to 10, and that's highly unlikely from here. From here, interest rates are either flat or down. And we don't really mind, because what's happening in the equity market and why you've seen this strong recovery is because going back to those earnings growth charts, the biggest companies in the world are actually growing. And so I know on the street it feels tough, and I know, people struggle to pay their mortgages, but you have to remember that the S&P 500 is not the economy, okay? It's the best 500 companies on the planet. The reason why I showed you that chart at the start about the few winners, it's important to remember that the S&P 500 is actually following the same few winners process. If you're a bad company, you get kicked out and forgotten about, and you never come back. And so the few winners keep coming into the S&P 500, and these are just 4 companies in the United States, in the top 20 companies in the world, 4 we happen to own, and they're all growing earnings aggressively in 2023, or since that March bottom. The first is obviously NVIDIA because of AI. Second would be a company like Eli Lilly because of GLP-1s. Or Ozempic. Third would be Visa, which never really missed a beat. You just changed what you spent money on. And even a company like Google started to grow. And so from our point of view, 1, you've had this big cleansing. 2, rates have peaked. And 3, earnings are growing again. And so from our point of view, this is year 1 of it's probably going to be a 5-year bull market. Because from here, rates are either flat or down. Earnings will keep growing for these biggest companies, and then eventually broaden out to the whole economy will start growing, because at some point we're going to cut rates. That second bit, I can't really tell you when it's going to happen, but amongst the biggest companies, they're already growing again. And the last thing I'd just say is, look, people would complain about valuations. I get, people are like looking at valuations going, oh, they're really high. They're a little bit high. 31 times is a little bit high to be paying for the biggest companies on the planet. but they are growing their earnings at 40%.
Yeah.
On average, and you're not paying 99 times earnings for some of these things like you were in the dot-com bubble. So yes, things might be slightly ahead of themselves, like a little bit, but this is like year one of a 5-year bull market. Like I said at the start, I've been through a lot of these. And so, yeah, I recognize that the returns have been very strong in the last year. That's exactly what you expect in the first year of a bull market. Returns won't be as strong as that going forward, but they should still be positive and firmly positive for a number of years ahead, would be our view.
Now, I think you've picked up on this in the previous slide, Nick, with the 4 stocks in there, but you like to break the fund into areas of interest rather than JIC sectors. Can you maybe talk about some of the areas of interest that you're pursuing in the fund at the moment?
Yeah, so our job, okay, so let's assume you believe everything I just said. So rates are flat. Rates are flat to either down from here. And earnings growth drives stock prices. We know that. So our job is to identify areas of structural growth and identify the winners. And so right now in the world, these are the areas where we see strong structural growth. And so if you are invested in our funds and you get the monthly reports, we publish this every month and every quarter. It's in the monthly report, it's in the quarterly report. And so this just shows you the areas where we see strong structural growth and the potential winners. And the biggest one is high performance computing. So this is high-end semiconductors, makes up 17% of the fund. Today, it's got 5 holdings, of which NVIDIA is the biggest. Second area would be digital enterprise. So this is software. We think they're also big winners of AI. So both of these companies are basically betting on the AI structural trend. This is software companies, 17% of the fund, 4 companies. ServiceNow is one of the biggest, along with Microsoft and a couple of others. And so from our point of view, what you're looking at these 2 areas is basically us saying we think AI is a structural computing shift. It's only happened twice in my career, like the internet and mobile and now AI. And we want to find the companies that are going to benefit from that, because that shift is creating structural growth, a structural tailwind. That structural tailwind equals structural earnings growth, and earnings growth equals share price growth. So that's those 2. Below that, we have some climate investments. So these are companies that help decarbonize the planet. And again, these actually 2 have become a little bit interlinked in the fact that, that AI trend is demanding so much power. And the companies that are needing all that power also have the strongest net zero targets, like Microsoft, Google, and Amazon. So that's causing a big uplift in renewables and an uplift in things like nuclear energy. Below that, we still like digital payments. So we still think there's a tailwind left in cash to card. And also, things like breaking down like cross-border. That's where we own Wise. Down here is connectivity. So this is us betting on a device cycle. So we do think there'll be a big device cycle, like we're all going to refresh our PCs and iPhones based on AI. And then right down the bottom is just digital media and content. That's us betting on, sports rights still going up. And here we own Formula One. So companies that are benefiting from increased value of sports rights. And so in all these areas, we're basically just saying, what's the area of structural change? That structural change, as I showed you earlier, will equal structural earnings growth. And that earnings growth, our bet here is to get the right companies that are, as I showed you earlier, occupying that top left-hand corner of the slide. And obviously the biggest one at the moment, and I'm sure we're about to talk about it, is AI. So the fund is very much positioned towards that.
Yeah, so AI, you
artificial
obviously don't
intelligence.
carve it out as a separate area of interest. But could you maybe sort of talk about artificial intelligence as an investment theme? It's a buzzword in markets, but I guess you've got to sort of sort through that and work out how you play it from an investment theme so that it makes money for the fund.
100%. Yeah. So maybe I'll just talk about that quickly. And obviously, look, important to flag, for those of you who were in, where were we last year, Leonda?
Yes.
We were talking about this a lot then. Okay. So it's not like we were talking, we just jumped on this in the last few months. This was something we spent a lot of time talking about, a year ago. Why is this a big deal? Okay, so there's a simple test you can do, by the way. So obviously everyone on the call is probably thinking bubble, bubble, bubble. How do you know something's a bubble and whether it's real or whether it's a bubble? And there's a simple test you can all do, is do you actually use the product? And so if you're using the product every day or once every second day, and you're getting utility out of it, then it's not a bubble, it's real. And we would argue that I'm using AI every day now, and I think a lot of people on this call probably would be too. And if you're not, go give it a go because it's really cool. And so I would argue this feels very much like the mobile cycle. And so what I'm showing you on the left there is a picture of a mobile phone. And I think everyone on this call will remember the first time they saw an iPhone. An iPhone, put the internet on your telephone. But importantly, it was the app ecosystem that made it work. And look, I'm just going to share my experience, but I remember the first time I saw an iPhone and I was in a bar and someone Shazammed a song. If people know what Shazam is, they pushed Shazam. It listened to the music and told you what the song is.
I thought that was heading in a very different direction there, Nick, when I saw Tinder on the...
Yeah, it was. And I thought that's the coolest thing I've ever seen. I'm going to buy one of these. And so I threw away my Motorola Razr, which cost me $200, and I went and bought a $1,000 iPhone. And then importantly, the iPhone created the app ecosystem, which created trillions of dollars of value. So about 3 million apps were created. And 99% of them went to zero, like everything in life. And 1% of them created trillions of dollars in value. Okay. Facebook, Uber, Spotify, Strava, Google Maps. And then you could also point to, Tinder, WhatsApp, TikTok. All of this value was created off the mobile ecosystem, okay? And then every company in the world leaned into it. So your bank created a mobile app, your airline created a mobile app, your health provider created a mobile app, which made their businesses better or helped them beat their competitors, if that makes sense, okay? Generative AI on the right should be exactly the same thing, okay? So you've got a structural shift in computing, which effectively allows everyone to lean into it and make their business better, okay? So a retailer will use it to help predict store traffic. You'll use Duolingo for translation. You'll use Adobe Firefly to create pictures. You will use GitHub to help you program. Companies will use it to design buildings, digital twins, etc. And so every company in the world right now is going to lean into this technology. It's reasonably obvious. And we knew that a year ago, but since then, and I can even show you, I've got some videos, there's all these apps that have started to come out. And so this is Adobe Firefly. I don't know if anyone uses it, but you used to have to, it's for trawling through pictures. You used to have to use the whole image gallery to find all these pictures. Whereas now, if I play the video, you can just use words. So say we want to create some Munro Mountains. We want them in the summer. We can say summer, say we want them with a lake running through the middle. It'll turn it to a lake running through the middle. And say you want wildflowers in the foreground, you can put wildflowers in the foreground. And eventually you get the picture you want. And you can see quite quickly that by plugging this into a generative AI model, that someone's going to pay an extra couple of dollars for that. Yep. I've even got one more example for you, Patrick. This is Pinterest. Yep. Pinterest used to be a boring website where you'd scroll to, fix up your living room. You can now use it to shop because they've plugged it into an AI model. Like it can plug straight into the websites where you buy the products. And so say we want to look like George Clooney this summer.
Why not?
It's in Italy. Here's George. You can find George. You can click on his sunglasses and it'll tell you where to buy them. It's basically just plugging it into an AI model. If you want to look like a mall, here's a mall, literally a picture in the Daily Mail. You can find the handbag. You click on the handbag. It'll tell you where to buy it. It's a $3,500 handbag, by the way. So this could get very expensive, is my point. And so the point is that you've got a product, and I'll even show you one last one if you want.
Yep, please do.
Like this is March 2023, okay? So here's me, top right-hand corner. I'm doing a webinar from a year and a half ago, okay? So you could have jumped on before this call to 45-minute webinar. That takes too long. You can basically go copy the URL, paste it into Gemini, which is Google's AI, and say, what was Nick Griffin saying a year ago? What were his best ideas from this webinar? It'll watch the YouTube, listen to my voice, turn it into English, and then summarize it for you. And this is what I said a year ago. And that takes you that just saved you 45 minutes of your time. And if you read closely, it says we're constructive equity markets. It says we like high performance computing. It says we like NVIDIA. So that would have been helpful to watch. But it also says we like luxury goods because we were excited about China reopening, and that was wrong. So 2 out of 3. But yeah, this is you can see how these products are going to be useful. So how do you make money out of it? So what's going to happen here, same as the mobile ecosystem, you'll get thousands and thousands of apps created. I just showed you 3. whether you pay for them or not, we'll see. These thousands of apps will all need to plug into these OpenAI models, but none of it's going to work unless you're in the cloud. Okay, so all your data has to move to the cloud at speed. The cloud's owned by 3 companies: Microsoft Azure, Google Cloud, and Amazon Web Services. So they are the shovels in this boom.
Mm-hmm.
And those companies will spend all of their money gearing up to host all these large language models by spending money on NVIDIA chips and the NVIDIA supply chain. And that's why NVIDIA is obviously ended up being the big winner of this. And so right now we're in the shovels of the boom phase, and that's how we've positioned for it. So that's our high performance computing ideas, and those are our software ideas. But as time goes on, and I think this is really important to think about, these amazing applications are going to appear. Okay, so when the iPhone was created, Uber didn't appear till 3 years later. Spotify didn't appear till 4 years later. Okay, so there will be these amazing applications that appear that makes it just a really exciting time to be doing our job.
Yeah.
And so then lastly, just to finish, and I know I'm on a long answer here, I apologize, but I think it's important.
Very good.
A lot of the performance you're seeing in the last 12 months is because of all the work we did a year ago on this. Okay, so these are the semiconductor ideas that ultimately are the shovels in this boom. And so it's not just NVIDIA, it's things like the tools that you need to make them, it's the foundries that make them, it's the memory that goes on it, it's the advanced packaging that goes on to building, an NVIDIA chip that looks like this. Okay, it looks completely different to a normal chip. So you're structurally changing the way you make semiconductors. And, our job as your growth manager is to go and find the companies that benefit from that.
Now, just while we're on NVIDIA,
Yep.
can't get away without asking the question, Nick. Largest position in the fund, 9%. It's done very well. I read something a little while ago that to justify the current valuation, the stock needs to grow at 20% a year for the next 20 years. Now, there's been a couple of companies that have done that. Microsoft and Apple, absolutely unbelievable businesses. So I guess, what would you say to that? And what's your view on NVIDIA at the moment?
Yeah, so importantly, let's go back to the MasterCard example and use it for NVIDIA. Okay, so this is NVIDIA's earnings over the last 5 years, and we've owned it for 5 years, by the way. So we bought it back here in 2019. So this is the earnings, and this is the PE multiple over time. Okay, so if you look at NVIDIA, the PE multiple is traded between 25 times earnings and 60 times earnings, and this is their earnings. And so what's happening here is the stock, just like MasterCard before it, is effectively just following its earnings. The multiple, interestingly, today is exactly the same price we paid for NVIDIA 5 years ago. Okay, so the stock's gone up roughly 15 times in that time horizon. And arguably, if I'd never sold a share, I can assure you my position would be much bigger than the 10% it is today. But, I think, some people would freak out if NVIDIA was 20, 22, 23% of the fund. But from our point of view, this is the multiple over time. This is the earnings. Okay, so to answer your question, you need to work out where this earnings number is going to go. Okay, the multiple's not difficult at the moment. 36 times is actually only 30 times today. The question is where does this earnings number go? And this is the bit that we have a model for. So we built a model. We built a model years ago, and we think it can get to $50 in EPS. We thought it could get to $50 in EPS all the way back here. And just importantly, that drawdown in 2022, NVIDIA was the biggest chunk of it because we held our NVIDIA position all through 2022. The reason why we did is because we just firmly believed that this could happen. And it did. And so that 25 number gets to 50, 30 times 50 probably gets you $1,500. That's a point where we'd seriously think about selling some. Because we're not sure we can get much above $50 without some sort of digestion. Yep. But long term, there's a clear argument you can get to $100 in EPS here over a long period of time. But I'd suspect there's going to be some bumps along the way, and we just need to be mindful of that. But we would argue NVIDIA is one of the few. We would argue and have argued for a long time that NVIDIA will become the biggest company in the world, and we're getting pretty close to that today. Yep. We should be, as I said, just year one into this AI shift. If these apps become as useful as what everyone thinks they are, then people are going to be buying NVIDIA product for a very long period of time.
Yeah, and just sort of your exit strategy, as you mentioned before, is just when for a stock like Nvidia or anything else in the portfolio, it's just when the numbers no longer add up. Yeah.
Pretty much, yeah. So we have a price target, and if it gets there, we think about selling some. And we have trimmed Nvidia along the way, as I said. But the other way it goes out is if it falls 20% from peak, we're forced to review the position under our stop loss protocols, and we might end up selling it that way. But this is, like I said, occupy the top down, left hand sort of the side. We always thought this was possible with Nvidia. We've owned it for years, and all the work we've done has thankfully led to this great return. We are now managing the life cycle of that position. We're probably at least halfway through it. But at some point, we'll have to find the next one.
Understood. Now, perhaps the one that caught my eye, and again, focusing on GIG sectors, I know that's not how you look at things, but consumer discretionary was about 11%. And just sort of referencing your point a little bit earlier, Nick, you made the point that the share market doesn't match the economy, and perhaps in the economy, there are people sort of struggling. So I'm keen to sort of understand where you get structural growth from in this part of the market, given where interest rates are at and the pressure on consumers as well.
Yeah. So we would argue, yeah, we agree with everything you said. But ultimately, this is creating an opportunity to buy consumer companies we like. And so when you're in a downturn in the consumer, like we are right now, these stocks get punished and ultimately give you an opportunity to buy a brand that you've always wanted to own. And so that's sort of how we're thinking about consumer right now. And so it's coming up over time. And we're basically picking through that wreckage of 2022 that we just talked about. These are some of the companies we like. This one's actually gone, so I can delete that. There you go. There you go. I'll just update the deck while we're talking.
I've never seen a portfolio manager do that on the fly, Nick. I'm very impressed.
It's okay. These are the four we like at the moment. So On Running is, for those of you who know, is On a Cloud running shoes. I'm sure some people on the call have them. It's an IPO that came in 2021 at like 80 times earnings. We like the business. We didn't like the price. We can now buy it at sort of 30 times earnings. Airbus, we've owned for years. We like it. It's just, there's only two people who make planes and everyone wants to travel, and one of them's in trouble. Chipotle is a rollout story of like Guzman Gomez here in Australia. And Shark Ninja, if you're interested, is Ninja blenders and Shark vacuum cleaners. It's a sort of a Dyson copycat business that's taking a lot of share in the US, etc. Best example I'll show you here is just Chipotle. So what are we doing in terms of a growth business?
My wife was in the US about 15 years ago, Nick, and she came back to me. She said, how the hell do we buy a Chipotle franchise in Australia?
Yeah, no, I know. And they let it go. And that's what GYG filled the gap.
Yeah.
But yeah, it's a classic. Okay, so these restaurant brands are fairly good growth businesses. You find something that works and you just roll it out. And so they have a concept, which for those of you who don't know is, fresh Mexican food. It's exactly what GYG is doing here in Australia. And as you can see here, you basically take share. So these are the number of restaurants in the US, for instance, of Domino's restaurants and McDonald's restaurants. And you start with like 1,000 units and you just grow them over time. You're at 3,500 units now. You should get to 7,000 units in the States. And then eventually you start rolling it out in other countries. What that means is, this is the earnings growth of Chipotle. It's basically a straight line, assuming, the concept keeps working and assuming you execute on your rollout, then you basically just manufacture earnings growth because the payback on your stores is the same wherever you open them. The best thing about Chipotle is really the price we got it for. So we've always liked it, but we had to pay 60 times earnings for it in 2020, 2021. And the reason why is because, as we discussed before, interest rates were 0. Now interest rates are 5. So the 60 times went to 30 times, i.e. the multiple compressed. But the business didn't change. And so you basically got a chance to buy it at a much better mathematical setup. And that's how we're thinking about all of these consumer stocks we're investing in. We're basically buying them when the risk reward is more in our favor. And hopefully Chipotle keeps rolling out restaurants. The earnings will keep growing. And if the multiple stays the same, then the share price will go up.
Just maybe touching on that, maybe a stock that fit into this category a number of years ago was a Starbucks. How do they sort of avoid the sort of financial disaster that Starbucks became for a little while there?
But it still is, it's definitely something we're thinking about shorting. So Starbucks is the basically this model at the end.
Yeah.
So they've rolled out 25,000 stores in
Yeah.
the US alone.
They're effectively eating into each other's market share,
They're
weren't they?
effectively saturated with
Yeah.
stores, and then they're saturated with concepts, and they're now even saturated with price. So you can't grow stores, can't grow price, and you can't grow meal times. So like the other option is, you move in, Chipotle could move into breakfast, for instance. They don't do breakfast. Starbucks doesn't do dinner, for instance. I don't know why you'd go there for dinner, but
I was just going to say.
but that's what a McDonald's would do. So McDonald's would
Yeah.
just find other parts of the day to sell to. But
Yeah.
eventually you just run out of white space, as they'd call it in America. You can't open any more stores. You can't put the price up anymore, and you can't come up with any more concepts, and so you effectively run out of growth. If you run out of growth, you run out of earnings growth. You run out of earnings growth, your share price stops.
Yeah.
That will happen to Chipotle one day. It will. Like Chipotle will be saturated. We're just nowhere near it today.
Yeah.
And then the market is obviously pricing it for that, because it trades at 40 times earnings now, and even at 60 times earnings. So the market is assuming this growth will continue. My point is like, if you get it at 30 times, your setup is better on a risk reward point of view.
Yeah.
And so that's what we're trying to do with consumer. You're trying to get that upside and not pay for it.
Now, I know I wouldn't say Chipotle is a household name here, but certainly is in the US. And we've spoken about a lot of mainstream names. I know you found some value in sort of the mid and small cap segment of the market, Nick. So maybe could you give us an example of a position that you've introduced into the portfolio that perhaps our clients and guests dialing in perhaps haven't heard of?
Yeah, and I'm just trying to find a slide. So we showed you at the start there. I'm just trying to see if I've got the slide here. Bear with me, because I am jumping around a bit. I don't think I have it. I'll show you just really quickly here. We did launch a small cap fund. This is the small cap fund. We launched it in November, sort of a soft launch, because we felt it was a good time to do it. And a lot of these small cap ideas, the reason why we launched this fund, and also the same reason why we launched the climate fund, I've just found a slide, is because how we think about the world is a bit like this. This is MAET, these are the global funds, and our climate leader strategy and our small cap strategy are really trying to find those ideas that we know are there, that I'm just encouraging the team to look for a bit more and to own them in these funds, and then they potentially will graduate to the big funds. In those small cap ideas, a lot of them are in our same areas of interest. So like in digital media, we own Pinterest. In climate, Constellation Energy Service now, we own Wix. They're basically in our same areas. The one that I would point out that has been a very, very good performer for us is, which I had on the slide earlier, is actually Shark Ninja. So again, it's an IPO that sort of appeared in 21, 22 when the market was in terrible shape. No one really looked at it. Chow on our team, who runs the small cap fund, brought it to my attention. Incredibly cheap company, makes vacuums and blenders, innovates in the kitchen, 15 times earnings, and growing at sort of 20, 30% per annum. And it's been a really, really strong performer for us. That and On are the two that have really performed well for us amongst the small cap, that a lot of people, we think are emerging growth stories. But most importantly, emerging growth stories at great prices. And for those of you who don't have a Ninja iCreamy, which makes ice cream, I'd strongly encourage you to go get one. If you don't have a Ninja blender, you'll notice the difference. Anyone who shops for appliances will know this. And is appliances a growth area? The answer is it is, because the kitchen is the heart of your home now. People like to cook. People like to cook in front of their friends. And so people will spend their discretionary money on, quite frankly, air fryers, barbecues, outdoor grills, etc. That's what people want. Shark Ninja is the #1 innovator of these products in the world.
Interesting. Now, you just sort of touched on the Climate Change Leaders Fund. Can you maybe talk us through how you carve that up into the different segments, Nick?
Yep. And look, this is definitely well worth spending a bit of time on, because people should be aware of this. Okay, so decarbonisation, if you believe it or you don't believe it, I think the key thing I want to flag to you, it doesn't really matter. The reality is the biggest corporates in the world are committed to decarbonising. So Microsoft, Starbucks, Walmart, Home Depot, Taiwan Semiconductor, all have net zero targets, okay? They're all publishing sustainability reports that suggest they need to get there, and their investors, the superannuation funds, are effectively demanding it. So this is a self-fulfilling prophecy from here. Now, whether they do get to net zero, I don't know. Whether that's actually going to help, I don't know. But what I do know is they're going to spend a lot of money trying to do it. And we think it's roughly $50 trillion. It's split amongst a lot of things. So think about BHP. You know, they need to decarbonize the buildings they're in. They need to buy renewable energy. They need to think about what's powering their trucks, etc. That's how we split it up. We split it into these 4 areas: clean energy, circular economy, clean transport, and energy efficiency. These would be sort of the different areas. And so in our climate strategy, which invests just in these areas, we move this around actively. And in the main strategy, as I showed you earlier, this makes up about 15% of the fund. There's a big change happening here. The reason why our climate strategy has taken off and the performance of that has been even better than our main funds in the last 2 years. The big change that is happening is because of this, okay? So data centers, because of AI, are now, sucking up more power than the aviation industry. Looking forward, data centers are likely to suck up, roughly this 2.5% number is going to go to 5 and eventually to 10. So 10% of all the power in the world will eventually be used to just power AI data centers. And the reason why they're doing that is because AI is going to be so big and these companies are gearing up to process these models. They're highly intensive. They need a lot of NVIDIA chips. They need a lot of power. The companies that sell into these data centers are doing well. So that's companies like Comfort Systems that makes HVAC, that's Kingspan that makes insulation, that's Schneider Electric that makes the electrical components of any building. And then the last thing that's really interesting is a company like Constellation Energy, which is a nuclear power company. So we bought this company because they own installed nuclear fleet in the US. So they own 16 nuclear plants in the US. So not new nuclear, existing nuclear. We bought it because we knew that they would be selling. There just wasn't enough carbon-free power in the US and everybody wanted it. We thought they'd be able to sell it at a premium. And that's what happened over the last 2 years. We've owned this for nearly 2 years. They started selling to like Walmart, Comcast, Microsoft, carbon-free power at a small premium. But about 4 months ago, we spoke to them and they said, look, we're not selling them the power anymore, we're selling them land. And we said, what do you mean you're selling them land? And they said, well, they don't want our power anymore. They want the land around our nuclear power plants. And I said, why do they want the land around your nuclear power plants? And they said, well, they don't want to take carbon-free energy anymore. They want to build the data centers right next to the nuclear power plants. Yeah. And they don't just want to build them. And the reason why they want to do this is because they want to go behind the meter. So they go behind the meter, which means they get the energy straight from the power station without being on the grid. So without, having to deal with all the paperwork of getting a data center approved in some suburban location. And then the next really interesting thing they said is, okay, they want the land, they want to plug into the nuclear power, but how much power do they want? And they said, well, that's the funny thing, they want all the power. And so what you're now seeing is the hyperscale.
All the land and all the power, Nick.
Yeah, so what you're saying is the hyperscalers' plans around data centers are so big. And when I talk about hyperscalers, I'm talking about those big cloud providers like Google and Amazon and Microsoft. They're so big that they're basically taking up whole nuclear power plants of power to run these huge data centers. And they're paying huge premiums for that power to get it. So they're paying 80, 90% above the existing power price to secure that power. Because what's become clear is that power is becoming the impediment to the AI shift. And so our climate fund has eventually become somewhat linked to our AI investments. And the reason why I wanted to tell that story is because it's important that it's very hard for people in Australia to see this. But it's not often I talk to a company who I speak to once every 6 months and they tell me about something that we were just not talking about 6 months ago, and that will move the earnings of this company by a factor of 100%. And it's a utility. So this is a utility whose earnings are growing at 100% over the next 5 years. And so this is not, this happens in my career. And so the reason why I wanted to tell the story is because you've got to understand that the biggest companies in the world are basically gearing up to build the biggest data centers on the planet. So we're talking $50, $100 billion data centers. They're going to take a lot of power. And these companies also have the strictest net zero targets in the world. So this basically lifts the whole renewable ecosystem. because they're going to have to replace that power with renewables, etc. And so the whole renewable ecosystem has effectively taken off in the last 6 months. But again, I would stress that this should be just year one in what's going to take 5 to 10 years to build out. And so we think just an incredible opportunity to invest in these companies because no one's really looking at it. And we understand it because we built our climate fund 3 years ago. And it's really only just begun. And it's incredibly exciting that this stuff's actually happening because you just wouldn't have thought it would happen in my lifetime.
So it's an interesting one to close off on, Nick. I think I already know your answer to this one, but funds made 83% in the last 2 years, which is incredible. You know, do you feel that it's due for a correction, or are you very comfortable where valuations are at in this climate change portfolio?
Yeah, so here's the climate fund. So importantly, we launched it November 2021. Okay, so note to everyone on the call: don't launch your fund like 2 months before a bear market starts. Okay, it's a bad idea.
It's very good advice, Nick.
So we launched it at a bad time. We obviously had to manage it through that period, and now it's obviously having a very strong recovery. Importantly, the climate strategy is a satellite strategy, so it should not replace your global equity strategy. It should be for the, if you're interested in this area like we are. It is a very concentrated portfolio of 15 to 25 ideas. And importantly, it is a long-only portfolio, okay? So it's not got the downside protection that we talked about that the absolute return strategy has. So the short answer is yes, it will have pullbacks. It will. It's not going to go up in a straight line. I've been doing this a long time. Nothing ever does. So yes, it will have pullbacks. But ultimately, again, just talking to the companies that are doing this, they're not talking about something they're thinking about doing and they're going to, in 3 months' time, stop thinking about it. They're talking about 5 to 10 year build outs to gear up for AI. And those 5 to 10 year build outs are literally just beginning. And so we think this is a great place to be for the next decade. Because the decarbonisation agenda has actually only got better since we launched the fund. The IRA was passed in the US and Russia invaded Ukraine. And so you need to get off Russian gas, and you need to, AI, the IRA is pushing renewables, and now AI is pushing renewables even harder. So everything's basically got better. The fund just went nowhere for 3 years and is finally catching up. But again, we would argue this is very much an argument that you're year one if you just listen to what the companies are telling us.
Beautiful. Good place to end on, Nick. Thank you for joining us today. We always appreciate your time. To our clients and guests, thank you for joining us today. Stay well. Thanks again, Nick. Thanks very much for your time. Appreciate it. And last thing just to say, just really quickly, obviously I covered an awful lot. I just encourage you, I'm going to just give a quick plug to the website. If you wanted to catch up on anything I just missed or go into a bit further detail, but please don't be afraid to use it. Absolutely. And it's one of the best websites out there too, Nick. Thanks for your time. Thanks again, Nick. Bye-bye.